Let me start with a number that should terrify you and excite you at the same time. On any given Friday, 0DTE options that expire the same day they're traded, now account for over 50% of all options volume on the S&P 500, half. That number was under 5% just 5 years ago. This isn't a niche strategy anymore, this is the market. And if you're trading stocks or ETFs and you don't understand what's happening in 0DTE land, you are flying blind. So let's fix that right now. An option contract gives you the right, not the obligation, to buy or sell 100 shares of a stock at a specific price called the strike price. A standard options contract might expire in 30, 60, even 90 days from now. That time gives the trade room to breathe, room to be wrong and recover. A 0DTE option expires today, as in the clock runs out at 4 p.m. Eastern. That's it. No second chances. No waking up tomorrow and hoping it turns around. Here's why that matters so much. Options are priced using something called time value, the premium you pay for the possibility that the trade goes your way. The more time on the clock, the more that premium costs. When you're buying a 0DTE option at 9:35 in the morning, you're paying almost nothing for time value because there is no time. You're betting on pure immediate price movement, and that is the double-edged sword that makes this game so brutal. Let me give you a real example with real numbers. Let's say SPY, the S&P 500 ETF, is trading at $520. You think there's a Fed announcement at 2 p.m. that's going to push it up to $524 before close. You buy a 0DTE call option with a $522 strike price. Because it expires today and the market hasn't moved yet, that option might cost you 0.45 per contract. Since each contract covers 100 shares, you're spending $45. If SPY hits 520 files by 3 p.m., that same contract might now be worth 3 XIO. Your $45 turned into $300. That's a 567% return in 4 hours. If SPY stays flat or drops, that option goes to zero. You lose your entire $45. That's not a metaphor. That is literally how it works. The contract becomes worthless dust at 4:01 p.m. Now multiply that by people putting in $5,000, $10,000, $20,000, and you understand why both the wins and the losses on Reddit look absolutely insane. So let's talk about the mechanics that actually kill people, because it's not what most beginners think. The options world is governed by what traders call the Greeks, mathematical variables that determine how an option's price moves. On a normal 30-day option, these are manageable. On a 0DTE, 2 of them become absolute monsters. First, theta. This is time decay. Every minute that passes, your 0DTE option loses value, even if the stock doesn't move at all. In the morning, theta decay is relatively slow, but after 2 p.m., it accelerates into a cliff. By 3:30 p.m. on a flat day, even options that were slightly in your favor can be worth nearly nothing because theta has eaten them alive. Traders call this getting theta crushed. It's one of the most common ways beginners lose money. They're right about the direction and still lose because they held too long. Second, gamma. This one is wild. Gamma measures how fast your option's delta, its price sensitivity to the stock changes. On expiration day, gamma is at its absolute peak. What that means in plain English, small moves in the stock create violent moves in your option price. Both directions. This is why 0DTE options can 10x in an hour, but it's also why they can lose 80% of their value in 20 minutes on a small pullback. Brute. This is the knife Wall Street wants you to pick up by the blade. Here's what the big players know that most retail traders don't. Market makers, the institutions on the other side of your 0DTE trades, are hedging their exposure in real time using algorithms. When you buy a 0DTE call and the market moves against you, those same institutions are often selling into that move to hedge their book. They're not playing the same game you are. They have infinite capital, zero emotion, and systems that move faster than you can refresh your screen. So you're not just betting on the market, you're betting against people who built the casino. But here's the thing, and I mean this, some retail traders are winning consistently, and they follow specific rules that most people ignore. Rule 1, never risk more than 2% of your account on a single 0DTE trade. Not 10%, not this one feels sure, 2%, because you will have losing streaks and you need to survive them. Rule 2, trade during high volatility windows only, the opening 30 minutes and the hour before close. Middle of the day, 0DTE trading on flat market days is theta death. You're just watching your premium bleed out. Rule 3, stick to high liquidity underlyings. SPY, QQQ, Nvidia, Tesla, Apple. If you can't get in and out of a position in under 10 seconds at a fair price, you don't have a trade, you have a trap. Illiquid options have wide bid-ask spreads that eat your profit before you even begin. Rule 4, have a defined exit before you enter, either a target gain, say 50% profit, or a hard stop loss, say 75% down. Set it, honor it. No exceptions. The traders who blow up are the ones who say, I'll just wait and see when a trade goes against them. Rule 5. Don't trade on news days without understanding the implied move. Earnings, Fed meetings, CPI prints, these events create what's called IV crush, where the implied volatility collapses immediately after the announcement, even if the stock moves exactly how you predicted. Many beginners have made the right directional call and still lost money because they didn't understand this. Now, I want to talk about the platforms you should actually be using for this, because the platform you use matters more in 0DTE trading than almost any other style of trading. For serious 0DTE trading, I keep coming back to Tasty Trade. If you haven't heard of it, it's built by options traders for options traders. The interface shows you Greeks front and center. Execution is fast. And here's the thing that matters on 0DTE. They charge 0 commissions on closing trades. You're opening and closing positions multiple times in a single day. Commissions add up fast on other platforms and quietly destroy your edge. Tasty Trade eliminates that friction. The link is in the description. If you're earlier in your journey and want to learn the mechanics before risking serious money, Webull's options platform gives you free level 2 data and real-time Greeks in a cleaner mobile interface. I used this when I was building my understanding of how option chains actually behave on expiration day. Great for paper trading and getting comfortable with the speed of these moves before you put real capital on the line. And here's where things get interesting. A growing number of 0DTE traders are starting to use AI-powered automation to remove emotion from the equation entirely. Composer lets you build and backtest algorithmic trading strategies without writing a single line of code. You define your entry conditions, your exit rules, your position sizing, and it executes for you. In a market this volatile, removing your own emotional decision-making at 3:45 p.m. on a Friday might be the single most valuable thing you can do for your account. So let me be straight with you about who should and should not be trading 0DTE options right now. If you have high interest credit card debt, and with the average APR now at 19.58%, I know a lot of you watching this do, please do not use money you need for bills to trade 0DTE. I'm not being preachy, I'm being practical. The variance in these trades, even when you do everything right, is savage. Use money you have specifically allocated as risk capital. Money you can genuinely afford to lose completely without it affecting your life. If you're past that point, if you have an emergency fund, no high interest debt, and capital you've set aside specifically for active trading, then yes. Learning 0DTE options in 2026 with volatility this high and market sentiment this broken. There is real opportunity here for disciplined traders. But discipline is the entire game. The traders making money in this environment aren't the ones swinging for 500% on every trade. They're the ones making 30 to 50% on small, calculated positions, cutting losses fast, and staying in the game long enough to compound those wins. The casino wants you emotional. The market wants you emotional. The one edge retail traders actually have is the ability to walk away when the conditions aren't right, something the algorithms running against you can't do. If this helped you understand what you're actually looking at when you see those insane Reddit posts, hit the like button. It genuinely helps other people find this video who need to see it before they blow up an account they can't afford to blow up, and subscribe. Because next week, I'm breaking down exactly what a recession in 2026 actually does to options pricing, and the specific strategy that historically prints money when the VIX spikes above 30. With where the economy is heading, you're going to want that video the day it drops.